Now, one of the most pervasive, every organization that you will be a part of uses this management accounting tool. It's called budgeting. A lot of people think budgeting is a financial accounting tool. No, it's a management accounting tool. And what it does is it forces managers to plan and cost the activities for the next year, the upcoming year. So it's a planning tool. Then once the managers have set down their plan, then the budget becomes a control tool, because then we compare what actually happened to what the manager planned to happen. And in that way, if everything is happening the way they planned, Mafi Muskila, nothing to manage. However, if it's not happening that way, that's when you as a manager have to take some action. So Module 10 is how we use the budget as a planning tool. Module 11 shows you how we use the budget as a control tool. All right. So to begin with, we're going to look at the benefits of budgeting and the essentials of sound budgeting. And then we're going to go through each of the components of what is called the master budget. And that leads to a budgeted income statement. And then lastly, probably the most important budget is the cash budget, where we make sure we have enough cash on hand all the time during the upcoming year to meet all the expenses that we planned for in the budget. Okay. Now, the budget itself is a formal written statement of management's plans, generally for the upcoming year. Future time period is usually 1 year. And the plans are expressed in financial terms, flus, money. Okay. So this requires all managers to sit down together and plan. Of course, they're planning their own area of responsibility. They're planning the activities they're going to be doing in their area, but they're also aware now of what the other managers are doing in their area, okay? So therefore, the budget becomes a very good way, a primary way of communicating among managers and agreeing upon the objectives of the company and how you fit in to meeting those objectives. So you're one part of that company. Now, this process promotes efficiency because, you see, if you were going to be doing certain activity, you may learn that that activity has already been done by another manager. Or you can work with another manager to achieve something. In either case, you're using less resources, and therefore you're more efficient. So those are the real benefits of budgeting: communication and efficiency. And once I have the budget in place, it then becomes a way of evaluating the performance of a manager. How well did the manager perform in the upcoming year compared to what he or she had planned in performance? And that is the next module, the control aspect of a budget. Now, when you put together a budgeting, what you're using is actual historical data. And all that data is recorded in the financial accounting records. Recall, in financial accounting, the accountant records every business transaction that the business encounters from the day it started. Okay, so we have a lot of historical accounting data, and you use the accountant very often in helping you prepare that budget. You look at last year's and you ask them what they estimate and so on. So the accountants are very much a part of the management team when it comes to budgeting, but they don't do the budget. You're doing the budget. You're the one that's putting your name on it. Okay. And the budget's is the responsibility of management. Now, what are the benefits? There's always benefits and limitations to everything we do. So let's focus on the benefits. It forces you as a manager and all the managers in the company to plan ahead, to plan the activities. And those activities then are designed to achieve definite objectives of the company. And therefore, in achieving them or not achieving them, we have a means of evaluating performance. The budget is also an early warning system. Something is happening which we did not plan. So you see, the budget is a feedback mechanism. We say we're going to plan this. When it actually happens, we compare what we plan to what we happen. It's like going on a trip to Paris. You plan to spend so much on meals and lounge and hotel and entertainment. And as you're spending that, actually, that was your plan. But now as you're in Paris and you're spending that money, you're comparing what you're spending to what you thought you were going to spend. So again, back to budgeting, it makes managers aware of what other managers are doing. And so therefore you become very much aware of the company's overall operations. And lastly, if the budget is done right, it is a way of motivating people to achieve the objectives and the targets they have set down, or their planned objectives, okay, to meet them. So it's a motivating tool. Now, to be effective, the company should have a very sound organizational structure with the authority and responsibility at every level being expressed very clearly so that everybody knows how everybody's related to each other in terms of the organizational structure. Also, to be effective, the budget requires a lot of analysis and a lot of research, okay? And to be accepted, of course, it has to be realistic and accepted by all levels of management. Now, when we talk about a budget, we're talking about basically an operating budget. And we're planning the operations for 1 year, the coming year. For example, if your company starts the budget period January 1st, you would have been analyzing and producing that budget in September, October, and November. All right, but you're planning operations for all of next year, 2021. And then you break that down into months or quarters, 3 months. Some companies by week, depending on the kind of product. If they have a product that's very perishable, then they will budget on a weekly basis. All right, but nevertheless, the budget's long enough to provide a sustainable goal and short enough so that you can compare the estimates to the actual. All right. The basic budget goals past performance, we said that begins several months before the end of the year. And it all starts with the sales forecast. The sales forecast indicates the level of activity that the organization attempts to achieve each month for the next coming 12 months. All right. And so we want to look at what our share of industry sales are, and we want to plan to maintain that share and so on. Okay. So the whole process starts with the sales forecast. That's why in marketing you do so much in the way of market research. You look at general economic conditions, industry trends. You look at studies that have been done. You look at how much you plan to spend in advertising. You look at where you are in relation to your competitors. What kind of market share do you have? Do you anticipate any price changes in the coming year? You must build that into your sales forecast. And you must be aware that you may be affected by other developments, technological developments. So all of this comes into play in developing the sales forecast. because you see, the sales forecast is very, very important. Everything else on the budget, in the budget, all the other plans are based on the sales activity for the coming year. Now, in developing a budget from senior management's point of view, what you should do, or what a smart company does, is they have everybody participate in the budget. All the managers, right from the low-level managers all the way up to the senior managers. And in this way, it's called participative budgeting. Everybody participates. And the result is that you get a more accurate budget estimate. Because lower level of the management are closer to the customer. And they, of course, have a good feeling. Not only that, you as a manager feel that this whole process is fair because you participated in it. You were involved. Okay. So the overall goal of participating budgeting is that it produces a fair budget and the management feels that it's fair. Now, the risk, the opposite to participating budget, is called top-down budgeting. Now, in top-down budgeting, if you're in an organization like that, that means that the senior management has said, okay, this is going to be the sales forecast for the coming year, and so on. You guys build your budget according to that. That's called top-down. It's not participative. You did not participate in it. In a sense, you were told what you have to achieve. All right. So participative budgeting is the way to go. The trouble with participative budgeting is very time consuming. You'll be involved in a lot of meetings. And also there's another aspect to it, and that's this. You as a manager know that you are going to be judged. Your performance is going to be judged based on your budget estimates and how well you do. So there is a natural human tendency to build in what's called budgetary slack. That is to say, I know I'm going to sell 10,000. I'm pretty sure I'm going to sell 10,000 in Oman in January next year, but I'm not going to put 10,000. I could put 9,500. And that way I can make sure I'm going to meet my goal and even surpass my goal. Well, that's called gaming the budget. What we want is an honest estimate of the upcoming performance. So senior management is always looking for those managers who are gaming the system. Okay, so here we go, budget basics. When you start your management career, you're really down here at the departmental level, departmental managers. Okay, as you grow in experience and knowledge, you can move up to the plant level, then the vice president, and then you could be the head chief. So you see, everybody in the budget, everybody in the organization is involved in developing an effective budget. Now, we have what's called the sales budget and the production budget and selling and admin budget and so on. All those budgets together are referred to as the master budget. The master budget is the set of interrelated budgets that constitute the plan of action for the upcoming year. And there are two classes of budgets. The operating budget. That is, how much am I going to sell in operations, and how much am I going to produce, how much raw material, direct material I have to purchase, how much labor I need, how much overhead do I estimate, how much selling and admin expenses. So you see, what you're trying to do is project what the income statement would look like at the end of 2021. At the end of 2021, if everything went according to our master budget, the master budget and the budgeted income statement at the end of 2021 would be very similar. Here's your sales, here's your cost of goods sold, here's your gross profit, Here are your operating expenses. Here's your net income. That's the operating budget. Then on top of that is the financial budget. And the financial budget is to make sure that we have enough cash in order to meet all the needs, all right, of the company. Now, in addition to this, senior management has now another kind of, it's called a capital expenditure budget. And that budget is different. That's not what we're going to talk about. That represents plans that are 5 years down the road. For example, Abu Dhabi University for the last 5 years has had a capital expenditure budget of building a campus here in LA, and they've just done that. That's called a capital expenditure budget. That's usually that's done by senior management. That's not done by the sales marketing manager or the production manager or anything. This is done by senior management. So that's something aside. So when you hear them talk about the capital budget or the capital expenditure budget, that budget is different than the one we're talking about. That is a 5-year budget, and what they are planning is to set aside money to add to expansion and things like that. When we talk about a financial budget here, we're going to be talking about the cash budget. So we're concerned with two budgets here, the operating budget and then the cash budget. Now, this is an overview of the master budget. As you can see at the top, this is sales budget. Now, that has to be done very carefully because the production manager takes those numbers for January, February, March, April, May, and plans the production. We have to produce the product we're going to sell. So the production manager takes the sales budget and plans his production budget. Then the purchasing manager, who's responsible for purchasing in raw materials, direct materials, among other things. But we need materials in order to produce. And so therefore, he takes the production budget and he builds the purchasing budget to make sure that he has the material on hand when the production manager needs it in order to produce the product for the marketing people to sell it that month. The production manager then determines how much is required in the way of direct labor and the variable overhead and the fixed overhead that will be incurred in the production of the product. So these are product costs. There's your three product costs: direct material, direct labor, and overhead. But when he's planning, the direct labor, of course, is straightforward, but the manufacturing overhead budget, recall there's variable overhead costs and fixed overhead costs, so he has to plan that. Now, the variable overhead costs would be in relation to the production activity, okay? So he plans that. And that, of course, is your cost of goods sold: direct material, direct labor, and overhead. Then in the operating expenses, you have selling and admin. And again, both of these, selling has variable costs that vary with the amount of sales and fixed costs. And admin has variable costs too that vary both with production or sales and fixed. And then when we put all that together, what we have is the budgeted income statement. Here's my budgeted sales. Keep in mind when I say budget, I'm talking about future. A budgeted revenue is future revenue. A budget cost is future costs. So a budgeted income statement is not an actual income statement. It's an estimated income statement for the end of next year. And that's all called the operating budget. Then for our purposes, we're going to focus on the cash budget and make sure we have enough money coming in from sales to meet the production budget, to meet the purchasing budget, the direct labor budget, the overhead, and the selling and admin budget. We need the cash at the time that we incur those costs. So the cash budget is designed to make sure we have that. As I said before, the capital expenditure budget is more senior management. Once I have the cash budget, I can proceed to do a budgeted balance sheet. Cash, accounts receivable, inventory, accounts payable, and the capital. So I can do what's called a forecasted balance sheet or a budgeted balance sheet. Now, for our purposes, the master budget we concern ourselves with is the operating budget here, down to the budgeted income statement, and the cash budget. Any questions? All right. Okay, it all starts with the sales budget. We're going to go through a rather elaborate example of how this is put together. The sales budget is the first budget. Of course, everything hangs on the sales, and it's the best estimate of sales revenue for the next coming year. Every other budget depends on the sales budget. Okay? Here's an example. Sales budget is rather straightforward once you get the numbers. Hayes Company expects 3,000 units to be sold first quarter. We're going to, instead of doing it on a 12-month basis, we're going to do it on a quarterly basis, which is 3 months. And every quarter, they figure the sales is going to increase 500 units. The selling price is $60 per unit. So, like I said, the budget is a formal written financial statement. Here's the sales budget. Rather straightforward. There's your 4 quarters, and there's your total for the year. Budgeted are expected unit sales, increases by 500. And by the end of the year, I have 15,000 I should have sold. The selling price does not change during the year. It's $60 for the whole year. So there's my estimated sales for the whole year for Hayes Company for the year ending 2014. So the sales budget is rather straightforward. However, the production budget is not as straightforward as the sales budget because we have to produce for inventory. So the production budget shows the units, just the units that must be produced to meet the anticipated sales budget. Now, management knows how important it is not to stock out. The worst thing you can do in business is make a sale but don't have the product available for the customer. That means you stocked out. You made the sale, but the product is not ready to be sold. So to protect against that, management sets a policy for the production manager. And that policy is inventory, finished goods inventory. And what they say is, look, you must produce enough product to meet the sales forecast in the first quarter of next year, plus have 20% in finished goods of what you need for the second quarter. And you do that every quarter. You produce enough to meet the needs of that quarter and a certain percentage to meet the needs of the following quarter. You see, inventory is a buffet. It's a cushion. In case the sales forecast is way out, we still have inventory. If we sold a lot more than we expected, we can pull from inventory and we can make adjustments. So in preparing a production budget, the production manager must take into consideration what the management wants as ending finished goods. So he produces to what the sales budget says we need for sales in the first 3 months of next year, plus a certain percentage of the second 3 months of the year. They want to make sure you end up the end of the first quarter with a certain percentage of what you need in the second quarter. That's finished goods inventory. But you don't produce to both of those because you see this is consistent. So what was produced the quarter before this quarter was enough to meet the sales of that quarter and the ending inventory, which is this quarter. So in every quarter, I must produce to desired ending inventory, but I also have a beginning finished goods inventory. That was produced last quarter. So therefore, the formula is budgeted sales unit plus desired ending finished goods minus what I already have on hand. And then what I have on hand is the ending finished goods from the previous quarter, which is the beginning finished goods of this quarter. And when I calculate that, I get the required production. So here we go. I already know what the sales budget says. I'm the production manager. I know what the sales budget says, and I say that management says they want 20% of the needs for the next quarter. All right. So I start off the first quarter here. From the sales budget, I go back to the sales budget, we need 3,000. All right. We need 3,500 in the second quarter for sales. Now, management says in the quarter one, I must have 20% of what I need in quarter two to meet the sales. So 20% of 3,500 is 700. So in the first quarter now, I need 3,000 to meet the production, 700 to meet the ending finished goods. I need 3,700 units, but I don't have to produce 3,700 because I already have some finished goods on hand from the year before. The quarter before in 2013, the last quarter of 2013, we produced 20% of what we're going to need in quarter one here. So you see, we produced 600 units to meet the 20% of the 3,000. So I already have 600. I need 37. So therefore, my required production is 3,100. Now, quarter two, I need 35 from the sales budget, 20% of what I need from quarter three sales. All right. So 20% of 4,000 is 800. Therefore, I need 4,300. But look, I produced 700 at the end of quarter one. That becomes beginning inventory in quarter two. So I subtract the 700 and I produce 3,600. Okay, so in quarter three then, I need 4,000 from the sales budget plus 20% of the next quarter in the sales budget, which in the case 900. And I already have 800, so it's 4,100. And then they have to tell me that there's 5,000 in this year here, so I get 20% of the 5,000. And so on. So that's how I build the production budget. I have to take into consideration ending finished goods inventory in my calculation. Are there any questions on that? So you see, this is a little more involved than the sales budget. So it's more likely than the sales budget would be on the exam. Okay. By the same token, the purchasing manager, who purchases in the raw material to meet the production manager's requirements, also has to maintain a raw material inventory or direct material inventory, because you don't want to run out of direct materials to produce the product, because then you can't produce and then you can't sell. So by the same formula that we just did, basically for the production manager, we're going to do for the purchasing manager, but this time we're talking about direct materials required for production. So the production budget tells us how much we're going to produce. We calculate how much material we need to produce each unit. Plus, we have to have a desired ending inventory of materials, and that will be expressed as a percentage, like it was before, of of next quarter's requirements. And again, we have beginning. Put that all together and we get the required direct material units to be purchased. Okay? So the budgeted cost of direct material to be purchased over here, required units of direct material, and we work in units right down to the last part of the budget, and then we multiply through by the cost per unit. Okay. And as it said, if we run out of inventory, there's a shutdown of production. So here, back to Hayes, we have the production budget, which is built on the sales budget. Management's policy here, again, requires that we maintain an ending inventory of direct material or raw material equal to 10% of next month's production requirements. So this time it's production requirements. Now each unit that I produce of this product called Right Ride requires 2 pounds of raw material, and the cost is $4. Assume that the direct materials were 1,020 pounds at the end of last year. Prepare the direct budget. Okay. So from the production budget, here's my quarters again. And from the production budget, I take the number of units I need to produce to meet the production budget, and I multiply that by 2. In the second quarter, I need 3,600 times 2, I need this. Third quarter, I need this. Fourth quarter, I need that. And last quarter, they're going to tell us. So that right here, 6,200 is the total pounds I need to meet production for the first quarter. So I need to have on hand 6,200 to meet the production. But I also have to have 10% of what I need in quarter 2. In quarter 2, I need 7,200. So, 7,200. So I need 720, 10% of that. So in total, I need 6,920 units to meet my production and to meet management's policy of 10% of next month's purchasement requirements. But I already have 10% of this 620 from the previous year. So I already have 6,200. I already have 620. So I don't have to purchase 6,920. I need to purchase 6,300. Now notice when you do the purchase budget, you don't do it in dollars. It just gets really confusing. Do it in units, and then on the last line, multiply through by the dollars. You have to express the direct material budget in dollars. Production budget is expressed in units, okay? But the direct material budget is expressed in dollars, but you only multiply through by the unit cost once you determine what your needs are in units. And you get 25.2. Now, in the second quarter, I'm going to need 7,200 plus 10% of what I need in the third quarter, 820. Those together is 8,020, but I already have, you see, the ending raw material budget or direct material budget in quarter 1 is the beginning direct material or raw material budget in quarter 2. The ending in quarter 2 is the beginning in quarter 3. The ending in quarter 3 is the beginning in quarter 4. So now I work it out that I need 7,300 times 4, and I get my purchasing budget for the whole year. Okay. So those two are the complicated budgets, the production budget and the purchasing budget, because you're dealing with inventory. Now, you can't inventory direct labor. You need to have them available when you need them. And therefore, the direct labor budget is rather straightforward. You need the direct labor to produce. So you simply look at the production budget. How many units do I need to produce in this quarter? how much time does it take to produce one unit? And how much do I pay per hour for each unit? And I get the total direct labor costs. So direct labor hours are determined from the production budget, of course. 2 hours of direct labor are required to produce each unit of finished goods. The anticipated hourly rate is $10. So we go to the production budget. First quarter, 3,100 units need to be produced. I multiply it by 2, and I get the total number of hours. And keep in mind, I'm working in hours here. Then don't work in dollars, work in hours, and then multiply through by the $10, and you get 62,000. So you can see how valuable Excel, the program Excel, is in developing a budget. You make a mistake, you just correct it. In my day, it was pencil and paper, and when you made a mistake, you had to go through everything to correct it. So anyway, you get the direct labor budget in dollars. Now, the third cost element in manufacturing is manufacturing overhead. And keep in mind, now that you know how costs behave, manufacturing overhead is 2 types of costs. Variable costs, which varies, all right, because I'm talking production, it varies with the production. And there's the fixed costs that doesn't vary with production. So here, Hayes Company expects variable costs to fluctuate with production volume on the basis of the following rates of direct labor hours. So every direct labor hour, the indirect materials are going to be $1, the indirect labor is going to be $1.40, utilities are going to be 40, and maintenance will be 20. Thus, for 6,200 direct labor hours to produce 3,100 units, budgeted indirect material would be 6,200 times $1. The labor would be 6,200 times $1.40, and so on. All right. Now the fixed costs are fixed and has nothing to do with the production volume. So we do this in 2 parts. Again, your 4 quarters, but the top part are your variable costs. Now you have to go to the production budget. And in the first quarter, you're going to produce you're going to need 6,200 direct labor hours. Sorry, you go to the direct labor hour budget. You're going to need the direct labor hours for the quarter 1, direct labor hours for quarter 2, 3, and 4, and you multiply that through for direct materials. It's the number of hours times $1. It varies. The indirect material varies with direct labor hours. The indirect also varies with labor hours, so it's $1.40 times each hour, and you build the variable cost here for quarter 1, quarter 2, quarter 3, all based on the direct labor hours consumed to produce the product. Now the fixed remains fixed. So in each quarter, it's 38.5, 38.5, and that's salaries, depreciation, property tax, and maintenance. So you understand those are fixed costs. So the total manufacturing is the variable 18.6 plus the fixed 38.5. I get 67,100. All right, and that's all based on that. So when you want a manufacturing overhead rate per labor hour, you simply take the total here divided by the hours and you get $8, but that's kind of meaningless. That's how much of that is variable, how much is fixed. Anyway, that just helps you when you're going to do the cost of goods sold. Now, those direct material, direct labor, and overhead are your product costs. Keep in mind, we're forecasting the income statement. So the income statement has product costs, the cost to produce my product, and period costs, the cost to sell my product, and all the administrative costs of running the business. Those are period costs. And so we have to anticipate production. So like the selling and the admin, here they say the variable expense rate for sales sales commissions 8, freight out 1. Variable expenses per quarter are based on the unit sales from the sales budget. So the first quarter, they expected to sell 3,000. And so we build again. There's your expected sales activity. And for selling and admin, we're combining those two. And we're saying, okay, the variable cost of selling and admin is $3 per unit sold. So that's 9,000. $1 per unit sold, 3,000. So there's your variable costs. And your fixed costs remain fixed. And the fixed cost here, of course, is advertising. Now, a lot of people think advertising is a variable cost, especially if you're in a marketing business. It's not, it's a fixed cost. Sales salaries are fixed, office salaries, depreciation, property taxes, and so on. And there's your selling and admin. So now you see, I have my sales budget, my production budget, my direct material budget, direct labor, and overhead budget, selling and admin, and I can do an income statement. And I project that income statement, all right? And I estimate what my profitability would be. And so for the sales budget, so for the cost of goods sold is necessary to determine how much. So for every unit sold, the direct materials was $2 at $4 each. The direct labor was 2 hours at $10. And the overhead, remember we come up with that $8 to 16. So every unit sold costs us 44. Now I go to the sales budget, and the sales budget said I sold 15,000 units. So therefore my cost of goods sold is going to be 15,000 times $44, or 660. And there I have my projected income statement, all right, for the year ended 2014. From my sales budget, the 900,000, from my cost of goods sold, which I just calculated, 660, gross profit 240. Selling and admin, all right, I go back to my selling and admin budget. I take the total for the year. I get income from operation, interest expense, income tax, and so on. And I come up with my net income. Now, this is a projected net income statement, right? Or a budgeted income statement. Or it's also called a pro forma income statement. Pro forma means estimate. All right, that completes my operating budget. And you notice I can build quarter 1, quarter 2, quarter 3, quarter 4, and I can use my Excel and I can go right across and make the calculations and do all that. But the cash budget is different because I have to estimate my cash through the first quarter, because at the end of the first quarter, that cash balance is the opening cash balance of the second quarter. So I have to do this in sequence. I can't go across in determining it. But the cash budget shows the anticipated cash coming in and cash going out. And is considered by many, myself included, to be the most important budget. Now, simply put, it's only 3 sections. Cash receipts, that's cash coming in. Cash disbursement, that's cash going out. And if I need to borrow money because I don't have enough cash coming in to meet the cash going out, I have to have a good working relationship with the bank manager, and I have to be able to borrow money immediately to cover my deficit. All right. So basically, the basic format is this. I start off with so much cash. In comes cash receipts, total cash available. Out goes cash disbursements. and I compare the total cash disbursements to the cash coming in, and I either have an excess, that is more cash receipt than cash disbursements, or I have a deficiency, which means my cash disbursements, cash going out, is more than the cash coming in. And therefore, if I have a deficiency, I have to finance that, and I have an ending cash balance, which starts the next. Now, before we can do this, we have to look at the expected accounts receivable, or the expected revenue I get from, the expected cash I get from revenue sales. Also, the cash coming in primarily from sales, but I also may be selling some shares. I may be selling some assets, so I got some money coming in. I may have dividends coming in, interest coming in. I have to take that into consideration. The cash going out is basically payments for direct material and labor and overhead. Plus, if I have to pay dividends, I have to pay taxes. If I plan to purchase trucks or any other plant assets, those are the reasons for cash disbursements. The financing section actually has two sections. One, how much I borrow, and two, how much I repay. And when I repay what I borrow, I must add something for interest. Okay. So again, the cash budget, as I said, is prepared in sequence. The ending cash balance of one period is the beginning cash balance for the next. So I'm going to do it in quarters. So the ending cash balance in quarter one is the beginning cash balance in quarter two. And the ending cash balance in quarter two is the beginning in quarter three. How we build it from experience. And it's usually prepared on a monthly basis, effective cash management. And we must make sure that we have enough money available to meet the debt. So we do this forecast and we bring it to the bank manager and we say, look, as we're coming into Ramadan, we're going to be building up inventory. So a lot of money is going to go out and not so much money is going to come in. So we need to borrow money before Ramadan. After Ramadan, the revenue from sales will be coming in and I won't be putting out as much. So I'll have more money and I can pay you back. And so that's what you do. During the year, you have times where you really need money because you're putting out a lot of inventory. And then you have times where you don't need so much money because you're not putting out as much inventory and the revenue from the inventory you already sold is coming in. So that's the kind of projection you need to show a bank manager. And he will set up what's called a line of credit, which means he'll allow you to borrow up to 100,000, whatever you need. So if you happen to need 20,000, he'll put the 20,000 in your bank account. And if you need 10 the next quarter, he'll put another 10 in. However, if the third quarter you're getting a lot of money coming in, not so much going out, he'll take out the 20 or 30. So he'll control your bank account that way. So that's what you need then. So the cash budget to begin with. On January 1st, we expect the cash balance to be 38,000. Now, management's policy, again, like we had for inventory, we didn't want to run out of finished goods inventory. What we had for purchasing, we did raw material. We did not want to run out of raw materials because that way we wouldn't meet the sales. So we had management's policy, buffers. Management also has a policy here. And that policy is stated as a maintain a balance of at least 15,000. That means if at the end of a quarter you only have 13,000 left in the bank, you're going to have to borrow 2,000. You have to come up to at least 15,000. Okay. Then next quarter, if you have more than 15, you pay back the 2. That's how it works. Now, your principal cash coming in is from sales. And companies often give selling terms to their customers. 210 net 30, pay by the end of the month, stuff like that. So in past experience, a company knows that when they make a sale in this quarter, 60% of the sales are collected in that quarter. So if I sell 100,000 in quarter one, okay, 60,000 will be collected in quarter one. 40,000 or 40% will be collected in the following quarter. And they know this from experience. So the accounts receivable, they're starting the year off with 60,000 in accounts receivable. So that was 40% of the quarter before sales. So we're going to collect that plus 60% of whatever sales we make in quarter one. All right. Also, we expect a short-term investment. We're going to be selling for 2,000 in the first quarter. All right. Now, the other assumption here, direct materials. When I purchase direct materials, I have an account with my suppliers. And basically 50% of what I purchase in the quarter, I pay cash for in the quarter, and 50% is paid in the following quarter. So now I'm starting the year off with accounts payable of 10,600. Now that's 50% of the quarter before. And I expect to pay that in the first quarter of 2014. Direct labor has to be paid 100% in the quarter incurred. Manufacturing, overhead, selling, and admin all have to be paid. But be careful here, because in manufacturing overhead budget, there's depreciation. And depreciation is not a cash outflow. It's just an estimate. It's not a cash flow. So you add that back to the manufacturing overhead. And the same with the selling and admin. You subtract out the depreciation, or you take what they have, estimated expenses, and add back depreciation to get the cash. Management plans to purchase a truck in the second quarter. Okay. They make equal quarterly payments of the income taxes. And when they have to repay the bank, they repay them in the earliest quarter in which there's enough cash on hand, plus interest. So here we go. Now, before we can do the budget, we have to do a schedule of the timing of the accounts receivable. Now, keep in mind that we're starting the year off with the accounts receivable from the previous year. Okay, that's at the end of last year. The accounts receivable was 60,000. So I'm going to collect that in quarter one. Also in quarter one, I am going to do 180,000. The sales budget says I'm going to do 180,000 in sales. I collect 60% of that in quarter one, right? 40% in quarter two. So therefore, in quarter one, the cash coming in is this 60 plus 108. I expect to be collecting about 168,000 in quarter one. Now in quarter two, I'm going to get 40% of the sales I made in quarter one. Okay, quarter one, remember 60% sales in quarter one, I'm going to get 60% in quarter one and 40% in quarter two. And the same with the sales in quarter two. The sales in quarter two were 210. I'm going to collect 60% of that in quarter two, in the month of the sale, and 40% in the following quarter, not in the quarter of the sale. So in the second quarter, I expect money coming in of 198,000. Quarter three, I get the 40% from quarter two, plus 60% from quarter three. and quarter 4, and they have to tell us what the next quarter will be, and we get that. So there's my cash coming in from sales revenue for the 4 quarters. Keep in mind, I'm also selling something in quarter 1. Now, how about the cash going out? Same idea, accounts payable. So from last year, I haven't paid my accounts payable. So I start this year off with accounts payable of $10,006, which I will have to pay in quarter 1. In quarter 1, I anticipate from my budget, my purchasing budget, my direct material budget. If you go back to that budget, you see that I'm going to be purchasing $25,200 in quarter 1. I pay for half of that in quarter 1 and half in quarter 2. So in quarter 1 now, my total cash out is $23,200. Quarter 2, I get 50% of quarter 1 and 50% of quarter 2. Quarter 3, 50% of quarter 2, 50% of quarter 3, and quarter 4, and so on. So I have my cash going out. Keep in mind, I'm also going to be purchasing a truck. So here we go. Cash budget for the year. Quarter 1, and you just do quarter 1 all the way down, until you get to end of quarter 1. Quarter 1, I'm starting off with $38,000. In are my collections from accounts receivable, $168,000. Plus, I'm going to sell shares or securities that I own of another company, $2,000. So I'm going to have 170 coming in. I already have 38, so I have 208,000 cash on hand. I'm going to pay $23,200 for direct material, 62,000 from my direct labor budget. My manufacturing overhead budget, I got to be careful here. I take a look at that manufacturing overhead budget, which was $57,100, but $3,800 is depreciation, so I add that back, and I only need $53,300 cash. Everybody understand that? You go to the overhead budget, and it says in the first quarter is $57,100. But to get down to $57,100, you included an expense called depreciation, which is not a cash flow. You don't pay for depreciation. So you add that back to the 57.1, and the only amount you need then is the 53.3. You do the same for selling and admin. You add back the 1,000 depreciation. Income tax, I said $3,000 every quarter. So the total amount I need for this first quarter is $182,500. So income's $208, out goes $182,500. I have $25,500. Mathemaskela. Management says I need $15,000. I have more than $15,000. I have $25,500. So I don't have to borrow, and I haven't borrowed in the past, so I don't have to repay. So I end the quarter with $25,500, and I begin the next quarter at $25,500. Again, income's $198. I have $223,500. Out goes $211, because this time I am buying a truck. And $223,500 minus $211,500 gives me a balance of $12,000. So I am short of the $15,000. So I have to borrow, and they'll say borrow in $1,000 lots, what have you. I have to borrow $3,000 to bring it up to 15. I start off quarter 3 with 15. In comes 228, out goes 220. I end up with 22,500. But I owe the bank $3,000, and the bank charges $100 interest every quarter. So I have to pay the bank back the $3,000 plus the $100 interest. All right. And when I do that, I subtract that from the cash. I have $19,400. I start off 19.4, in comes this, in comes that, and I have more money. And that's how the cash budget works. All right. So it's in sequence, and it's cash coming in, cash going out. You have to watch the timing of the cash coming in and the timing of the direct material purchases. Everything else straightforward. Watch management's policy